All right, well, hello everyone, and thank you for joining our webinar today, which is part of our Flying Blind Accounting Audit and Disclosure series. My name is Hannah, and I'm a communications officer at Carbon Tracker, part of the Tracker Group. So today we are going to be focusing on accounting and audit regulation and enforcement inconsistencies across jurisdiction and how they hinder transparency and therefore the efficient global asset pricing of climate risk, transition or otherwise. So to download this report, as well as the supporting slides, just follow the QR code shown on screen. Before we start, just a few housekeeping points. The intended runtime of this webinar is 40 to 45 minutes, depending on the number of questions asked, with a 60-minute hard stop. There will first be a short presentation of key points before we move to answering your questions. If you'd like to ask a question, please do so via the Q&A function. Please do not send questions anonymously, as this stops the team from getting in touch afterwards if they're unable to answer it live. And lastly, a replay of the webinar will be sent in the coming days. So Carbon Tracker is a not-for-profit financial think tank. Our vision is a fully decarbonized global economy well before 2050. All of our research converts climate science into financial risk and reward with the aim to accelerate the energy transition by mobilizing the financial markets. Our work, including this report, is all free to download and access on our website, as well as usual third-party platforms. In addition, accounting and audit work can be seen on specialist sites such as Climate Arc's Transition Arcs, CA 100+, and Climate Engagement Canada. So joining us today is Barbara Davidson, Head of Capital Markets Transparency. Barbara leads the team looking into whether the impacts of climate-related risks are included in financial statements and audit reports, as seen in the Flying Blind series. She has spent over 25 years and has experience prior to Carbon Tracker and has spent many years in financial markets and accounting and audit companies. And joining Barbara is Richard Folland, Head of Policy and Government Affairs, with a focus on financial policy. Richard has been with Carbon Tracker since 2014, and prior to that has spent 20 years in climate policy and private sector advisory. So Barbara, with that, over to you.
Thank you, Hannah, and thanks everyone for joining us this afternoon or morning. This slide talks briefly about what we'll cover in this slide presentation. I want to recap briefly the work that our accounting and audit disclosure team is doing at Carbon Tracker. Then I'll talk about the scope and methodology of the information that is in this regulator report that we're focusing on today, with the results and some key findings from our assessments and the regulatory overlay that we're including here, and then some potential regulatory policy actions that can be a follow-on from this work, and then we'll go to the audience Q&A. So with that, we can move on to the next slide.
Thank you, Barbara. Hello, this is my cue to come in. I'm Richard Folland, and great to be joining Barbara on this. Hello to you all. And so Barbara helpfully sort of gave us the agenda for this presentation. And I'm going to be the moderator for this session, and also I'm going to help Barbara to go through the presentation, asking a few questions along the way. So Barbara, here you're going to give us an overview, I think, of what the report covers. But I wonder in particular if you could draw out here why this work is important, and also why the focus on transparency as well, please.
Sure, thank you, Richard. And thanks for moderating so people don't only have to hear my voice today. So whenever I present, I'd like to remind people that why we're looking at financial statements. And again, this is financial statements, okay? Not the information that is included outside of the financial statements, financial reporting. So as a reminder, financial statements today, accounting requirements today, are not just including historical information. They also include forecasts about the future. For example, information that is needed when companies are testing assets for impairment, looking at their estimated useful lives, or estimating the timing of paying down liabilities. To measure those items when they're preparing their financial statements, they're going to have to, management will have to estimate things like costs, the timing, maybe there will be estimated production, volume, sales amounts. There might be price assumptions included in those estimates. The issue here, and why we focus on financial statements and the notes in the financial statements, is that climate and energy-related transition risks, such as regulations that can impact emissions, disrupted technology, we can have demand destruction, other types of risks, as well as companies that want to achieve their own targets, these matters can materially impact the information that companies use when they prepare their financial statements today. And those are the forecasts, the estimated assumptions and estimates that go into those forecasts that I was just talking about. The relevant accounting and audit standard setters have been very clear in the past and today that the companies and their auditors must consider these matters when they have a material impact on the financial statements today. So we would expect that these matters are included in balance sheets and reported profits today for companies that are materially impacted. If these matters are ignored, we could risk having assets that are overstated, liabilities that are understated, reported profitability that's overstated. Now, these matters can impact items such as management remuneration, investor models, companies' abilities to continue as with business as usual and as going concerns. And the transparency over these issues is important because that's effectively the information that investors are using to make their decisions, to make their models, to adjust their models. Also, the audit report is the key form of communication with the auditor's client, the investors. So if they, being investors, don't see whether or not if companies aren't indicating via notes of financial statements, auditors aren't indicating via their audit reports that they've considered the material impact of these matters for companies that are especially carbon exposed, investors do not know if they're using the right information to make capital allocation decisions. I think that's pretty much what I want to cover on this slide. Let's move to the next slide.
Thanks, Barbara. That's a great overview there, but also I think really for bringing out the transparency dimension. So this report, as we said, it's the latest in the Flying Blind series. And I wonder if you could give us a little bit of a recap on the previous reports in Flying Blind, but also why does this regulatory note differ from the others or from the previous ones? Thanks.
Sure. Thanks, Richard. So off the back of what I was discussing, why accounts are important, we have assessed, because the accounts are important, I should say, over the past few years, we have assessed a specific population of companies, the Climate Action 100 plus focus companies, most of those companies, financial reporting and their audit reports. And we assess those against what we're called climate accounting and audit assessments. Those scores are reported on various websites, including Climate Action 100 plus. I'll talk about the methodology in the next slide. But what happens then is we go through and we analyze the results and we publish them in our Flying Blind series. And what we've noticed over time, and you can see there have been a couple of reports now, we're in the third year, even though I've said 4+ years, we're in the third year of the Flying Blind series, is that transparency over whether companies have considered these matters, over whether auditors have considered these matters when they're auditing the significant assumptions and judgments that management is making. Transparency isn't really improving. There may be more discussions about climate risks, so there may be more discussions about targets, but whether the impacts of those are flowing through into the financial statements, so the balance sheet, reported profitability, et cetera, is not really improving over this population of companies. And this is despite the fact this population is effectively a carbon exposed population. That's the nature of the Climate Action 100 plus focus companies. And so we expect automatically for climate to be material to these companies. This is a global population, but they're subject to similar accounting and audit requirements for these purposes. The sectors that we assess are going to have similar exposure to these types of risks. So despite all of this, the transparency is less than ideal. Again, this means investors may not have the information they need to make efficient decisions, and it can impact their pricing and market efficiency. And so what we decided to do this year is to try to identify other rationale reasons for this poor transparency, other levers that investors and other actors might be able to push to help improve transparency. And so we looked at, in this note, we're looking at a regulator overlay to see if there's any relationship between regulatory activity and the disclosures that we're finding. And we're also looking at we're looking at an auditor overlay in a note that will be coming out in a couple of weeks. I think, again, that's pretty much, oh, thank you. Going to the next slide. Moving right along.
Exactly, seamless, eh? So thanks. That is a sobering point, I think, that you make about the little improvement in the financial statements on transparency, and maybe we'll get into that a little bit in the Q&A. But perhaps we could go into some of the detail of the report here, Barbara, on the scope and the methodology. In particular, maybe if you could tell us about the the business sectors which you and the team analysed, but also something here about the geographies, the jurisdictional breakdowns as well, please.
Sure. So for the regulator note, we ended up looking at the jurisdictions for, let me just step back for a minute. We looked at fiscal year 2022 financial statements for this assessment, and I'll talk about that in the next slide in the results. But that's the population we looked at. We wanted to highlight regulatory activity, look at specific regulator activity, but we couldn't look at all jurisdictions. So we looked at the highest represented jurisdictions by headquarters. And so that ended up being 97 focus companies. And you can see here on the right side, those are between 5 jurisdictions, okay? Australia, EU, Japan, UK, US. They're not obviously evenly represented, but that's the way the population has come out. And then on the left side, because we looked by headquarters, automatically the sectors fell out of that. And so obviously, energy is a hugely important sector in this matter, and you can see it's represented quite significantly. We also have industrials that is represented well, and then we have transportation, another important sector, and then consumer goods and services. So those sectors and the focus companies are all expected to be either materially impacted by climate risks and maybe their own targets, or contributing to the energy transition, if you will. Now, the assessments used a methodology called the Climate Accounting and Audit Assessment Methodology. That's the methodology we've been using for the past few years. That methodology is essentially grounded in existing audit and accounting requirements today. And that methodology uses 7 underlying metrics. We decided when it was written, they would be evenly weighted to assess these various factors, which includes assessing financial statements and disclosures in those financial statements, audit reports and the disclosures in those, and then also some alignment with net zero, which is an investor request, which is not necessarily founded on requirements, but not prohibited. And so that's the assessment we use when we're looking at these companies before we put the regulatory overlay there. The other thing I would mention is we understand the sample size may not draw definitive conclusions, but they can help us identify trends because regardless of the sample size, the observable activity by jurisdiction is the observable activity by jurisdiction. So hopefully that makes sense and gives a little bit more kind of color to the what we looked at and the methodology we used. And we can go to the next slide on that.
That's great. Thanks, Barbara. So that was the scope and the methodology. Maybe here, if you could move a bit into telling us about the results of your findings, and also, maybe if you can draw us any contrasts, either within the sectors or perhaps within those geographical jurisdictions.
Right. So we didn't have it. This does not have a sector comparison, but I can just talk a little bit about what's on the slide. Again, these results relate to the metric assessments, the climate accounting and audit assessments that we do. And what happens is those underlying 7 metrics that I mentioned, we score them based on there's a traffic light system that we use to score them. That is not met the criteria that we are using to assess them. Partially met the criteria. That means the companies or the auditors are providing some of the information, some of the transparency investors need, for example, to make their investment decisions, or yes, all the criteria have been met. Now, the slide on the left effectively shows the overall scores for the 97 companies combined, unweighted. And you can see none of the companies, to be fair, no company in any of the assessments we do meets all the 7 metric criteria. So, but almost half have partially met this, means they have partially provided the information that we think investors need, or investors have said they need, and that also is required today to, under the accounting and audit standards, to make their investment decisions, to allocate capital, to ensure market transparency and efficiency. The red, unfortunately, is the opposite, right? It means that investors have no transparency. Again, we're not saying we don't know if the companies did or did not do what they should be doing, or the auditors, if there's no transparency. What we're saying is the investors don't have transparency over whether these material risks are included in the balance sheet and the profitability today? And so do they have all the information they need to effectively engage, to value these companies, to adjust their models, to make capital allocation decisions, which could be impacting the capital transitioning capital to perhaps lower emitting activities or more effective products. So that's the general, that's the overview of the scores. And then you can see by jurisdiction where the jurisdictions come like above or beyond that overall scoring result. And it's interestingly, I'll talk about our key findings, but the jurisdictions that are scoring, well, I'll talk about this in our key findings, but you can see here, for example, the UK, all the companies and auditors that we looked at have provided at least some information, right? Japan has most of the information we looked at was not giving the information that investors need. So they've had almost all no's. And then you can see it's a little bit more mixed for Australia and the EU. Unfortunately, you can see the US isn't providing the information. The companies and the auditors aren't providing the information that we're looking for today that investors need. And from that, we can move on to the next slide.
Thanks, Barbara. And I think you've hit the nail on the head there with the sort of the key question, really. I mean, how can an investor or anybody else make a judgment on whether these companies, how they're addressing climate risk or not in the financial statements if they're not publicly disclosing in the first place? And just talking about questions, if I could encourage the audience, please, to post questions on there, it would be very good to, we have a few more slides to go through, but if you could start to think about and maybe to put one or two questions up there, that would be great. So as you said, Barbara, now you're going to be moving from the results to, to some of the key findings, and, just interested to hear what you've got to say about this. And I suspect we're going to hear a little bit about the value of enforcement as well, but over to you. Thank you.
Sure. So effectively, what the results are showing us is that effectively the assessment results mirror the levels of observable regulatory activity. Remember, the only way we can do these assessments in terms of this regulator note is by what we can observe. There's no other way of determining if regulators have done something or not. It's the same as disclosures. So otherwise said, we think that one of our main findings is that regulatory prioritization over the treatment of climate-related risks in financial reporting and audit reports may improve reporting quality, because our scores, our results are effectively a proxy for the quality of reporting, again, in financial statements, audit reports, over the extent to whether these matters have been considered by companies and auditors today. A few other interesting notes or findings, if you will, is that audit report disclosures, so the information that auditors are giving to investors about how they've considered especially for their key or critical audit matters, the impacts of material climate matters, material energy transition risks, achieving company targets, when they're testing the items that are subject to significant judgment and estimates, those disclosures actually lag behind what we're seeing in company financial statements, even for the same jurisdiction. So for example, if a company is talking about what it did when it prepared its financial statements, auditors may not always be addressing like whether they did assess the impacts when they did their audits. So without that information, we don't know the extent to which auditors may have challenged management's assumptions, may have performed their own sensitivities, may have done their own tests using credible information, credible climate-related information. Again, as you saw in the results, the EU, UK company financial statements audit report information, the disclosure quality lead, and we're seeing that the observable activity in those jurisdictions is there's much more observable activity around supervisory priorities and enforcement. Japan and the US lag, and there's much less observable activity, where Australia sits in the middle. And it's interesting because they have some focus on financial reporting and enforcement or supervision and oversight over that, but they're primarily looking outside the financial statements, at least what we can observe. So all this also leads us to say that the willingness and the capacity of these regulators, the financial and audit regulators, to signal to companies and auditors and to enforce the existing requirements, which is key to this, right, is key to getting better disclosures out there. And I think that's what I want to say on that slide, so we can move to the next slide.
Right.
Yes,
Thanks
sorry.
very much, Barbara. So excellent. So if those were the findings, I mean, how should the financial regulators and other stakeholders as well, what are the takeaways really for them in terms of what actions they should take? So I think it'd be really interesting to hear from you on that. And maybe I think in the next slide as well, perhaps breaking that down a little bit by again by geographical jurisdiction as well. But over to you, Barbara.
Sure. So we can see, so we've done a breakdown by relevant bodies, as you've mentioned, again, with the financial regulators, continue or start undertaking what we're seeing called as climate-related thematic reviews, where the regulators are pointing out the importance and looking for considerations of climate-related risk, the energy transition risk, company targets in not just outside of the financial statements, but in the financial statements. That is, again, the observable activity related to that seems to be exact or directly related to the quality or the results that we're seeing. We're also seeing monitoring of specific issues such as impairment, and that could also be impacting the quality of the disclosures in the company financial statements today. From an audit regulator standpoint, I won't talk too much about this because I don't want to spoil our audit note that's coming out, but generally speaking, audit regulators should increase the emphasis of the disclosure of these matters and transparency over these matters in their audit quality reviews, so that they can signal to auditors that this information is, whether or not this information is in compliance with the existing requirements today. They can also collaborate with the relevant standard setters. From a global body standpoint, these bodies are key to helping. They're well positioned to coordinate action by the relevant bodies that they oversee. So they should continue or start coordinating activity. They should prioritize enforcement. They should address jurisdictional issues that can all contribute to the consistency of information that's being provided in various markets to investors. It can also help signal the way in which the requirement should be implemented. And that can help maybe address any jurisdictional questions or confusion or differences. Professional bodies, such as accounting or auditor bodies, are really important here, obviously, because the people that are doing this work are often members of these bodies, and those bodies have a wide global network, and they can share best practice, they can provide guidance to their members, they can build the capacity and capability of their members through education and other tools. And this is they're a huge part of this whole system. And then, of course, investors can continue to engage on the need for better information and oversight. And we're seeing some investors writing letters, for example, to the SEC. We see investors talking to various regulators, and they should continue to do that and signal to regulators whether they are getting the information that they need today. So that was a lot. If we move to the next slide, and we can talk about, I think, yes, right. So I'm going to talk a little bit about some jurisdiction-specific action points. In the EU and the UK, again, we're seeing significant or significantly more observable activity, as I mentioned, and we think that's reflected in the results. And we would encourage these jurisdictions to maintain that focus on financial statements and audit reports. I know there is some focus now on information that's being provided outside the financial statements, such as the sustainability disclosures, which are also very important, but we would encourage them to maintain their focus on the information in the financial statements as well as outside. And consistency in their approach across jurisdictions and together is vital, again, for global market efficiency, transparency, and for investors. In the US, understanding there are challenges, regulators can still clarify, can still prioritize the importance of reporting these risks in the financial statements and in audit reports today. And then, of course, we have Australia and Japan, and we're seeing more, as I mentioned earlier, discussion on information that's being provided outside of financial statements, outside of financial reporting. We would encourage them to emphasize the reporting, the importance of reporting, and better disclosures of this in financial statements, in the relevant audit reports. And I think from that, we can go to the next slide, where Richard is going to have a chance to actually speak. And so, Richard, turning to you, I mean, maybe you could speak a little bit more now about the action I talked about from maybe a more regulatory standpoint. Could you talk about the actions that policymakers can take to improve the information that investors are receiving today?
For sure. Thank you, Barbara, and glad to give you a little bit of a break. Uh, Also to say, good to see the questions are coming in now from the audience. So please keep them coming because this is our final slide, and so we will move to audience Q&A after this. So yeah, what we wanted to do really was to make that connection between regulation and policy. Given that it is the policymakers, it is the government departments, usually the finance ministries, who are the policy and political masters, as it were, of the financial regulators. They're the ones who sort of set the overall frameworks, the mandate for the regulators. And often, particularly if we're looking at more sensitive or newer issues for financial regulators, the government departments, the policymakers, they can provide that political cover as well, which is important. So three thoughts here really on actions that we would like to see these finance ministries, policymakers take. First of all, we think very simply that it would be helpful for them to become more aware about this issue, particularly if you go back to the breakdown that Barbara was giving earlier about the sample and the different carbon intensive sectors in particular, which the team analysed their financial statements. Energy, industrial sectors, transportation, all really important as far as climate and emissions are concerned. And, what can the policymakers do actually to engage with their regulators, perhaps to support them more in terms of their ability to be proactive, but also, this key point that Barbara emphasized earlier, how the financial regulators can enforce actions and help to drive behavior change here. Second point, and we talk about this in Carbon Tracker a lot, where we see where there are gaps in financial policy and regulation, where perhaps that needs to catch up with policy and targets and so on relating to climate and the energy transition. And so really encouraging here more of this whole of government approach, a more coordinated approach within government. I have this experience from working inside government myself, that government departments aren't always as joined up as you might expect them to be. And we think this is a bit of a gap here, really. He's coming back to this awareness point as well. But we'd like to see the finance ministries and the financial regulators more joined up here. And finally, and Barbara, you touched on this earlier, the international dimension. So we've heard here about the report goes into what's happening at that geographical jurisdictional level, but are there opportunities maybe for the international bodies such as IOSCO, which brings together the securities and regulators at the national level. There, IOSCO brings them together internationally. Could someone like IOSCO, maybe other international bodies, work more with the regional regulators and the national regulators actually to take work forward? I mean, opportunity based on our results here, one might have thought in Europe, but maybe across the board. Final point I'm going to make, and then we're going to go to Q&A, is that having published this report now, that we are very much doing some specific targeting of regional policymakers and regulators in order to draw the key findings of this report to their attention. So,
Thank you. Actually, can I
yeah,
go off
please,
piste here and
please do.
maybe
No, go on. Go.
ask you to, you talked about a more joined up approach, which I
Yeah.
guess maybe is a little bit different than this whole government approach. Could you elaborate a little bit on what or give us some examples of what a joined up approach might look like?
Well, I think it is. I mean, one can use various words. Holistic, perhaps, is one. Comprehensive is another. I mean, given that it is widely accepted the climate and the transition, these are issues relating to financial materiality. So in that respect, we have, say, the government department that's leading on national emissions reductions targets and net zero targets. And you know, how much are they talking to the finance ministries about this? Given that finance ministries more generally, their role not only for overseeing regulation, but also you know, relating to economic policy, relating to fiscal incentives around the transition as well, relating also to issues like carbon pricing. How much are these government departments talking to each other so there is this coordinated approach towards climate and the transition? I hope that makes it a little bit clearer. And yeah, great.
Yeah, that's really great. Thank you.
Barbara.
Maybe you're the moderator. Should I turn back to you?
Yeah, no, super. Thank you. And thanks very much for a couple of the questions that we have here. So I'm going to pick out, first of all, from Michael Esialuka, and I hope I pronounced Michael's name correctly. So Michael's question is, where regulations around climate risk reporting and disclosure are weak, is there data or information that advocates should gather independently to strengthen our arguments about investors scrutinizing climate risk? Thoughts on that, Barbara?
Okay, let me just think for a second. Well, I think so. We are seeing in the areas where I'm not sure if, yeah, I think I understand where you're coming from. We are seeing investors reference other, first of all, explaining why this information is important to them, to those regulators in those jurisdictions, and also referencing the fact that they're getting this information from other companies and others jurisdictions, which is making the information that's being provided to investors basically they don't have a level playing field. And so the role of these regulators is to ensure market efficiency and to ensure that investors are receiving the correct and reliable and I'm using non-technical terms, but they have the information that they need to make investment decisions. So if regulators are not helping investors get that, if investors can give regulators examples of other jurisdictions where they can get that, I think that's one way of doing it. I'm not sure, I'm just looking at that question again.
It's independent
if
source.
that's answering that question. For example, I think I mentioned earlier that we had some investors write to the SEC about the fact that they need more information about the quantitative assumptions and estimates that companies are using. And even if those quantitative assumptions and estimates are not including climate risks today or the impacts of climate risks today, if investors have that information, then they can make their own decisions and adjust their models accordingly. So reaching out to regulators and showing examples from other jurisdictions, I think is a powerful way for investors to do that. But I'm happy to have a follow-up question on that.
Right, thank you, Barbara. Now, an interesting question here from Sandra Vera Munoz. So the report you described, you know, a survey assessment of various of the sort of the carbon intensive sectors here, and Sandra's wondering about financial institutions who have got climate risk exposure. Wonder if you might be able to make a comment about transparency within financial institutions' disclosures in their financial statements.
Yeah, I can, generally speaking. So the Climate Action 100 Plus focus companies that we look at do not include financial institutions. This is not to say they're not important at all. It's just that our population is more on the industrial side, but there are other investor organizations that are looking at this transparency. For example, IIGCC has been looking at this, and there's also PCAF, which is around disclosures of finance emissions by the financial institution sector. Effectively, then, what I'm saying is it's just as important for transparency in that sector as it is for other sectors. It becomes more complicated because really it talks about, as you said, finance emissions can be looking at, for example, expected credit losses and where their portfolios are more at risk than other portfolios. But overall, I agree, this is an important sector, very much an important sector, and one that will hopefully maybe be able to start to look at as well, but that there are investors looking at today.
Great, thank you, Barbara. So another question here from Michael, which, I mean, I can take a little bit of a stab at, maybe you might want to as well, which is about the insurance sector.
Yep.
You know, what more can be done to promote climate risk disclosure there. Do you want to have a go at that first? I mean, if it's something you might want to address, but I can bring in 1 or 2 points there as well.
I mean, we can both do that. And thank you, Senator, for your response. Again, we definitely, okay, we agree that this insurance sector is a big issue, right? It's an up and coming, it's here. From the insurance sector standpoint, there are many ways to look at this, right? You can look at the insurers as an investor themselves. You can look at them as being an investee, their own risk, whether they're pricing it into when they make investments, whether those that are invested in insurers or being insured have those priced in, if the costs are reflecting the climate related and other risks. The big issue for insurers, as you would, as everyone would understand, is physical risk, which is, of course, an issue in itself because it's not as easily forecasted. But I'm kind of jumping around and in my thought process, but I would say that one of the main issues that is coming out is jurisdictions that are no longer insurable, if you will. So insurers are no longer going to provide insurance, say for residents or for mortgages. And so with climate or physical shocks, we're seeing some of these states are coming in what they call, I think it's fair play insurance. And that means that those states are going to cover the insurance, or if they can't, they will go bankrupt. So what does this mean? Well, this means that we need to pay more attention to what insurers are costing, what they're disclosing, if we're getting the information that we need, as an investor, as an investee from insurance companies, and what disclosures they're provided. So I agree that there can be activity at this level, and I think there needs to be a lot more activity from a disclosure standpoint and also from a policies and regulation standpoint. But maybe Richard, you could also take that.
Yeah, no, I have got a couple of thoughts on that. Thanks, Barbara. And you might want to look at the sort of further questions coming through in the meantime, including from Kai there about examples of best practice. Yeah, a couple of points I'd make. One is really to highlight, and I guess, Michael, that may well be why you asked the question. I mean, the insurance sector's it's such a major part of the financial ecosystem, both as Barbara touched on this as an investor, but also with insuring against risk as well, and with climate physical risks being in the here and now. And I think that the governments, whether it's the central banks, whether it's the financial regulators, I think they've got a key responsibility here to bring the insurance sector more into the conversation. One example I can think of is the Bank of England has a climate risk financial forum, which brings together various financial stakeholders like the banks, like the asset managers, the asset owners, but also there are a number of insurance companies who are on that forum as well. And so bringing these different major players within the financial ecosystem together, partly by bringing the different financial institution categories together, that in itself, and this has been a bit of a objective for the Bank of England here to drive best practice around disclosure, how they're addressing climate risk, some sort of commonality there. So more could be done here. I don't know if other central banks are acting, bringing together the financial actors there in the same way as I know the Bank of England is, but that's something that could be done more. So
thank you. And I accidentally said we answered Kai's question, but we didn't. So do you want to go to that one?
Yeah, I'm just
sorry about that. I hit the wrong
That's
button.
all right. So Kai, thank you for your question. So you asked if we could provide examples of best practice in climate risk disclosure per sector. So maybe, Barbara, if you can do that, but also anything you could say about the barriers for companies to disclose their physical risks, financial statements. Interesting questions. Thank you.
Sure. So we don't do necessarily best practice per sector. What we do in we have various reports and publications with examples of disclosures and which are better and which are worse, if you will. This flying blind. So starting with this regulator note, we have a few written examples. The audit note that will be coming out will also have but we'll have more written out examples of auditor disclosures. if we go backwards a little bit, the overview of this year's Flying Blind, I don't think has examples, but our prior Flying Blinds have a lot of examples of good practice. Nothing's best practice, if you will. We don't think anything is best practice yet, but there's a lot of good practice out there per sector. Now, just to clarify, I have to remind people that when we say good disclosure, it doesn't mean we agree with the company's transition plan or whatever they're doing in their activities around climate and the energy transition, but they are very transparent. That's what we're scoring. We also have company summaries that we publish, some summaries published on our website that you can find in our company profiles page on our website, and that will give a lot of information about how we've assessed some of these companies across different sectors for different years. So there are examples, but we don't necessarily do it by sector, which is a fair question. My colleague is in the room with me and they're just giving me something which I can't read. Yes, so we do have, for example, good practice in the oil and gas sector. Examples would be companies like Shell and BP. But again, these are just their disclosures. We're not commenting in our assessments about anything about the energy transition or what they're doing there, just to be clear. On the physical risk side, I agree it's more challenging in financial reporting, again, because we're using forecasts. And so from a forecast of the impacts of physical risks, well, we don't know if we can forecast those costs. What we can forecast, however, is, are your insurance costs rising? If you're no longer insured, what does that mean for your ability to continue to operate that asset? Do you have increased costs because you're going to have to around operating that asset in that jurisdiction, because perhaps you have to build a seawall or something that's going to increase the cost of staying there? Do you have to move that asset? Or those things that you might be able to are reasonable costs to include in forecasts in your financial statements? So there are things around the costs of operating those assets related to physical risk that I think can be put in financial statements today. But I understand that it's not as easy as, it's not as obvious for physical risk as it is for for transition risk, if you will.
Thank you, Barbara. So there's another question here, which I'm happy to have a go at first of all, which is from Arthi. And this is relating to, do investors have responsibilities here to, I guess, hold companies' feet to the fire in terms of what are they doing about decarbonisation, the transition and so on, and whether there are any reports from Carbon Tracker, which is really addressing this question of investor responsibility. And I wanted to give an example of a report that's just come out, and maybe Barbara, you might want to chip in with other examples as well. But we published our oil and gas team published earlier this week the latest in the series of Paris Maligned, as it's called. This is Paris Maligned 3, basically taking a look at surveying 30 oil and gas companies and what progress are they making or otherwise against the Paris goals. And that's an example there, that report, which has actually sort of listed questions there that investors can ask these companies, in particular, those investors with climate mandates, that whether, or that they should, really question the continued positions that these oil and gas companies are taking. I mean, the report includes recommendations for policies as well, for policymakers as well. I think the other point to make here is that the metrics in that report as well that investors might find useful in terms of being for transition risk exposure. So those might. Barbara, anything to add on this?
I mean, look, there are stewardship responsibilities for investors in different jurisdictions, and I think that's really where that has to focus. I understand where this question. I understand what this question is doing and where it's coming from, and it's a fair question. But investors really need to be able to show that their stewardship over their assets is, they're providing good stewardship over their assets.
Absolutely. And just to underline, Arthur, I mean, Carbon Tracker's reports as a whole, very much aimed at the finance and investment community. And here, we hope that investors very much can, take from these reports the recommendations, suggested questions that they can put to their investee companies. There's a final question here from Joel, which is about the auditing sector, Barbara. Now, you might want to say too much here because with the auditor note coming out later in the year, maybe if you just want to say something about this, and then I think we'll draw the webinar to a conclusion after that. Oh, hang
Yeah,
on.
I was just typing it to Joel, but
There's a
yeah,
final one come in, which
Joel.
actually
Oh, there's another one here. I typed the answer. I don't know. Can people see when I type answers? Anyway, Joel basically,
yeah.
yes, Joel understood that is an issue. We've discussed that. That's been discussed over time, and jurisdictions are having various discussions about how to address it, but it's not being addressed really effectively right now.
Thank you, Barbara. And actually, just the final thing that's coming here, it's not really a question. Thank you, Nigel, just pointing out to us that the Prudential Regulatory Agency for the Bank of England, they have disclosure requirements there, which are addressing, including for insurers. So great. Well, Barbara, thanks very much for that and for giving such detailed and informative answers. And Hannah, I'm going to hand back to you. Thank you.
Thank you, everyone, for questions. Really appreciate that.
Thanks, Richard. And yes, so looking forward, as Barbara mentioned, the next installment in the Flying Blind series will focus on auditor transparency regarding climate and transition risk practices. But for now, the latest reports from our oil and gas program, as Richard said earlier as well, Paris-Maligned, as well as Crude Intentions 3. Paris-Maligned focuses on the oil and gas sector alignment with the Paris Climate Agreement, and Crude Intentions 3 looks at whether C-suite incentives align with shareholder value. And there will be a short webinar covering both of these reports on the 24th of April. Invites are going out shortly. So want to just thank Barbara and Richard, the wider comms engagement team, Simon, and you for spending your time with us today. Best wishes and goodbye.
Thanks, Hannah.
Thank you again, everyone. Goodbye.